Hi, I'm Eric Irvin, CEO and founder of Reality Shares. We're an exchange-traded fund issuer primarily focused on all things dividend growth related, and particularly things that have to do with the future dividend growth of either a company or the market as a whole. So we're highly focused on that forward-looking estimated dividend growth. Today I want to talk to you in particular about a model that we've built in order to predict which companies are most likely to grow their dividends versus those companies most likely to cut their dividends, and how much those companies are likely to grow their dividends in the future. We call it DIVCON. It's based on the DEFCON system of 5, 4, 3, 2, 1, where defense condition, in this case the dividend condition or dividend health of a business. So first let's get into the tidy little disclaimer here. What we're talking about is the overall institutional marketplace and the research underneath that. So this is, again, not meant to be a sales tool. It's not meant to persuade anyone to do anything with their investment dollars. It's really just meant to be an educational background for institutional investors to understand the methodology underneath the Reality Shares research. In particular, in this case, related to that DIVCON system and methodology. So some of the information that I talk about will be based on back-tested results, and again, I'll try to indicate wherever that's related to back-testing, I'll try to indicate the time period. But of course, you can find all this and more on our website at realitysharesadvisors.com. Thank you. So again, Reality Shares, we're totally focused on looking forward and trying to understand which companies are most likely to increase their dividends and have the highest potential for increasing dividends in the future. And I guess let's just first jump right into why even bother. What does it matter with dividend growers? What does it matter whether a company grows its dividend or keeps it the same? Well, it's pretty important. Dividends as a whole, if you think about the S&P 500 in general and you just zoom in on that, and over this 20-year period here, dividends made up almost 40% of the total return of an S&P 500 investment. So if you were an investor in the S&P 500 and you did not focus on earning those dividends and reinvesting those dividends, you would have given up almost 40% of your overall return. Globally, it's even bigger. So globally, dividends account to almost 93% of the total return of an equity investor or a stock market investor. MSCI did this study a while back. And more importantly, and I think this is the thing that most people miss, is the growth of dividends over time made up the biggest portion of that overall total return. So the growth of dividends amounted to about 64% of your total return for an investor in a global stock market. And if you break down companies in the S&P 500 as a whole, and you look at the different categories from dividend growers and initiators, dividend payers that keep the dividend stable, to non-dividend payers, and finally, ultimately, to the cutters and eliminators of dividends, you find that the returns granted by the companies who grew their dividends or initiated their dividends were meaningfully better than the S&P 500 or than the rest of the market as a whole. And actually they did so with even less volatility. This chart here demonstrates the average return on an annual basis on the y-axis and the average standard deviation or risk that you'll earn that return. So kind of that variance around that return. And so obviously where you want to be here is up and to the left, and that's exactly what you might actually expect. Companies who are growing their dividends tend to be a little bit more stable. They have a lot less volatility associated with them versus companies who might be cutting their dividends or eliminating their dividends. I want to be clear, though, this is entirely based on back-tested results. So Ned Davis did this study going all the way back to 1972. But what the point is here is that if you were lucky enough to pick the companies that grew their dividends, you would have had superior results to all of those other categories. The problem is what if you were the one to select the companies who cut their dividends? You thought it might have been a dividend grower, but then they ultimately ended up cutting their dividends. You could have gotten a little bit misled here. And then going down to the next level of the research, and this is really where I think a lot of dividend growth investors start to to at least open their eyes to the real potential behind dividend growth. It's not just if a company grows its dividend, it's how much the company grows its dividend. So we ranked all the companies, in all the 2,000 companies into quintiles, basically the largest 2,000 companies in the US, went back all the way back to 1992. And those companies, again, based on hindsight, those companies with the highest dividend growth had meaningfully outperformed the S&P 500 by almost 8.7%. So the companies with the highest dividend growth rate, not just if they grew or if they cut, but the highest dividend growth rate outperformed meaningfully over the S&P 500, whereas those companies with the lowest dividend growth rate tended to underperform the S&P 500. And also interesting to note, I think a lot of people focus on that, how do I get more yield out of my portfolio? Well, those companies that underperformed tended to have the highest dividend yields versus those companies with the highest growth rate had the lowest overall yield. So I think this is a clear indication of not to fall for the yield trap, that sometimes those companies with the highest yield end up having lower overall total returns because they just don't have the oomph in order to get those returns delivered. You know, when we're investing in stocks, typically what we're looking for is companies that can grow their earnings and their revenues and their cash flows because we as investors want growth. But if a company has either a more tired industry that's been around for a long time and doesn't have the growth there, or the company is just down on its luck, usually the yield will be higher, but the growth won't be there. So now let's take a look at some of the current strategies that are in the market in order to identify companies that are growing their dividends. So the typical strategy out there, and we're just going to highlight 3 in this case, are entirely based on the rearview mirror approach. So what they're looking for are companies that grew their dividends in the past, and that's typically the only screen out there that's going to be applied to this. These first 2 categories, the S&P 500 Dividend Aristocrats Index and the NASDAQ US Dividend Achievers Select Index, are based on this strategy of looking at companies, in the case of the aristocrats, who have grown their dividend every year for 25 years in a row, or in the case of the dividend achievers, every year for the last 10 years in a row. And then finally on the right here, the NASDAQ Dividend Achievers 50 Index is taking those top 50 companies based on yield, so the highest yielding companies out of the Dividend Achievers Index. What happens if those dividends don't rise in the future? Well, then you're left holding a company that doesn't increase its dividend. Again, because this is entirely based on history. And so it's a rear view mirror approach that sometimes has a fatal flaw associated with it. And we just want to get into a couple of those here. 1, those companies tend to have lower growth rates than the S&P 500 as a whole. So if you look at this x-axis here, this is the average annual dividend growth rate of the Achievers Index, the Aristocrats Index, and the Achievers 50 Index. They all have lower dividend growth rates than the S&P 500, and they all have lower earnings growth rates than the S&P 500. And if you look at the size of the circle, which is the revenue growth, they all have lower revenue growth than the S&P 500 as a whole. So yeah, they may be nobility, and they may be the aristocrats in terms of having grown their dividends for many, many years in a row, but they're missing the bigger point, which is the amount of growth that they're producing for the shareholders. And so in a way, they're essentially hiding in the closet and trying to hide behind this low growth scenario where they really can't produce those kinds of returns in the future. If you look at it as a portfolio of ETFs and mutual funds, so what we did was right here, what we looked at was all of the ETFs that are dividend focused, US based, and large cap in nature. And we looked at the holdings of every single one of those ETFs, and we ranked them based on dividend growth rate. So S&P 500 is this black box here in the middle. So the S&P 500 on a 1, 3, and 5 year basis had a higher dividend growth rate than the Achievers, the Aristocrats, and the Achievers 50. but also actually than most of the dividend-focused ETFs out there in the market. And we plan to expand this research out to mutual funds as well, but right now we just wanted to keep it to ETFs. And so you can see there's very few ETFs out there who even have a dividend growth rate on average better than the S&P 500. And certainly the largest three, the Achievers, Aristocrats, and Achievers 50, all have dividend growth rates even less than the S&P 500. So what about cuts? Well, what about when we enter into the financial crisis? Again, when you're looking at a rearview mirror approach, you have to worry about running into that brick wall. And in this case, that brick wall happened to be the financial crisis. When on the left here, the Dividend Achievers 50 index saw nearly 48% of the companies in that index cut their dividends, and the average cut was nearly 75%. On the Dividend Aristocrats, again, this is the nobility of all the dividend-paying and dividend-growing companies. Nearly 25% of them cut their dividends, and on average, they cut the dividends by nearly 70%. And on down to the Dividend Achievers, this is the most popular dividend growth ETF in the existence today. Nearly $30 billion is allocated to this and other mutual funds that follow this same strategy. Almost 18% of the companies cut their dividends, and the average dividend cut of the cutters was almost 80%. All of them, across the board, had more as a percentage of holdings cuts than the S&P 500, and more as a percentage of overall cutting, so more magnitude of cuts than the S&P 500. These are the companies who are supposed to be the aristocrats, the kind of the elite of dividend growers, and yet they underperformed the S&P 500 when it came to the two things that they're focused on more, which is number of companies that are increasing dividends and the average dividend growth of those growers. So moving on here. So we developed a system that tries to sift through and rank companies based on their ability to cut. We went and looked at all the different factors that we could possibly think of and get our hands on of every single company in the large cap US universe. And we wanted to analyze, do any of these different factors or characteristics, are they any good at predicting which companies will grow their dividends or which companies will cut? And then also, furthermore, what about the magnitude of that dividend growth rate? So what we came down to was dividend estimates, earnings payout ratio or dividend payout ratio. A lot of the common things that a lot of people look to for current dividend growth rates actually had a number of different flaws, and so it wasn't any one characteristic in particular that worked very well at predicting dividend growth. What we had to do was we had to combine a lot of different factors or characteristics together in order to come up with a fairly accurate model that was good at predicting which companies would increase and which companies would cut, and then even furthermore at predicting which companies would increase the most and vice versa, which companies would increase the least. And we came up with these 7 factors, and when you combine those 7 factors with the appropriate weightings, you come up with this DIVCON score. And that DIVCON score, we then rank like a bell curve. The companies who are most likely to increase are in that DIVCON 5 bucket, all the way down to the companies who are most likely to decrease their dividends in that DIVCON 1 bucket. So 5 is the best, 1 is the worst. And putting it to the test. So now here we look at the last 15, 16 years of data, and if you were one of those DIVCON 5 companies in that leading category, you would have outperformed the market by a wide margin with almost 9.8% annualized returns with a standard deviation of just 15% versus the S&P 500. So you'd have had less risk than the S&P 500, more return than the S&P 500. And if you look at the bottom tier, those lowest quality companies, you would have ended up with a much, much higher standard deviation or overall volatility and a much less or lower return than the S&P 500 as a whole. So even just taking this system and avoiding those lagging companies, those companies most likely to cut, you would have outperformed the S&P 500. Even if you just took the entire S&P 500 and avoided those companies and rebalanced once a year, you would have outperformed the S&P 500. digging down a little bit deeper, so what we wanted to do is we wanted to say, now here's where we look at both backtesting but forward-looking approach. So we take out the rear view mirror, and now what we say is, if you were a DIVCON 5 company, what was your likelihood of increasing your dividend in the next 12 months? So in this case, you had a 96% chance of increasing your dividend in the next 12 months. Incidentally, we didn't see any cuts in that category. So again, so the DIVCON 5 companies, those companies that were fortunate enough to make such a high score on the first Friday of December of every given year, had no dividend cuts in the next 12 months and had almost a 96% chance of increasing the dividend in the next 12 months. On down to the DIVCON 1 category, where only 23% of those companies increased their dividends in the next 12 months. And I think in that category, there was about 30 or 36% dividend cutters in that category. But looking at it further, and again, this is what we would argue is the most important factor, is the ability to compound growth over time. It's like Einstein said, it's the most powerful force in the universe, is that power of compounding. Is the DIVCON 5 companies ended up with a very meaningful dividend growth rate over the next 12 months. So a company who had a DIVCON 5 category achieved a 16.3% annual dividend growth rate in the next year, whereas those companies in that DIVCON 1 bucket averaged a 0% dividend growth rate. So we had some growth, some cuts, and on average we saw almost no growth in that category alone. If you break this out, as they say, averages can often lie, and even a 6-foot-tall statistician can drown in a pond that's on average 1 foot deep. So putting this DIVCON test to the basically test under different regimes, we see during the 2000 to 2005 tech bubble period, the DIVCON 5 category achieved almost a 20% dividend growth rate versus the DIVCON 1s of 0. This is where I think is even most important, is that 2006 to 2010 time period, when those DIVCON 5 companies averaged 15% positive dividend growth. So these companies, during the credit crisis, during one of the worst financial periods in history, averaged a positive 15% dividend growth rate, versus those companies in that DIVCON 1 category had almost 31% dividend cuts over that time frame. And then moving on to the most near-term period, the last 5 years, where we saw almost a 16% dividend growth rate in the DIVCON 5s and then a 0% in the DIVCON 1s. So again, across different time regimes, different periods where we had different economic cycles going on, the research holds true, where if you achieve that DIVCON 5 category on that first Friday of December, and really over any period of time, and you look forward 12 months later, you see a meaningful outperformance in the dividend growth rate of these companies versus those other categories across the market. Now, kind of going back and looking at that previous example, so what about the earnings growth? What about the revenue growth? So you saw in this case the DIVCON leaders, we see almost 18% average dividend growth rate on a 5-year basis. Compare that to the S&P 500 of around 10.8%, and then comparing it to the other categories who all had lower dividend growth rates on average, these other dividend-focused rear-view mirror approaches. But also from an earnings growth perspective, so we saw meaningfully outperforming on an earnings growth as well as a revenue growth percentage. So again, it's just a system which one of the byproducts is the actual growth of dividends. But some of the undercurrents along there is just growth of the business. So what the system is doing is it's actually going through and it's filtering companies that have strong prospects for growing earnings, growing cash flows, growing revenues, the things that you pay attention to most when you're an investor looking for a growing business or a growing enterprise. And again, we would argue that growth of the business and earnings and some of those key business metrics, particularly the cash flow that the shareholder is receiving, is going to be the thing that drives the overall total return for the investor. And then kind of coming back and bringing it back down. So again, across all of the ETFs in the marketplace, and we will expand this research to all the mutual funds as well, but all of the dividend-focused US-based ETFs in the marketplace, the DIVCON Leaders Index would have had the strongest dividend growth rate, or does have the strongest dividend growth rate across the holdings of that index. There's about 50 holdings in the index today, compared to any of the other dividend-focused mutual funds dividend-focused ETFs in the marketplace today on a large cap basis. So meaningful when you look at what the key primary drivers of returns are in this dividend space. And then looking at it in a crisis period, again, with that forward-looking approach, because we're looking at the fundamentals of the business and because this model is actually sifting through which companies have strong earnings growth, strong free cash flow, strong share buyback programs, which they could ultimately cut if need be, strong credit scores from an Altman Z perspective. These are the things that are going into this system, and what that does is that forward-looking approach prevents a lot of the crisis period events like we saw in 2008 and 2009. So where the Aristocrats 50 index, or the Achievers 50 index, and the Aristocrats and the Achievers and the S&P 500 all experienced cuts and of a significant nature, the DIVCON Leader system had no cuts during the financial crisis, and obviously no dividend decline during that time period. So I just want to leave it there, and we can get into any of this information further on our website. I just wanted this to be an introductory means, but you can see here on the website we also have the underlying factors of the DIVCON system. We can provide this research if you reach out to our desk. We have a lot of tools on the website where you can type in a ticker and pull up the underlying DIVCON score of any equity amongst the top 1,200 equities in the market. This other tool where it's a market sector average DIVCON rating, so you can go back in time from 2017 all the way back to 2001 and look at the S&P 500 as a whole based on its DIVCON score, but then you can also dissect into the different sectors and look at the DIVCON score of every single holding in the S&P 500 going all the way back to 2017. Again, we want to be as transparent as possible with every one of our investment products and our investment research pieces that underlie those investment products. And so this is exactly why we put all of this information on our research website. And if there's anything that you're looking for that you can't find on our research website, please feel free to reach out and ask any one of us at Reality Shares. Again, the research website, which you're on probably right now, is realitysharesadvisors.com. And then we have our other website, which is where you can find information about our exchange-traded funds at realityshares.com. Again, thank you for listening. We appreciate all of your interest, and please feel free to drop us a note if you have any questions or concerns or comments. Again, thanks.